Hi, my name is Naadir Amzar bin Aslam. Today I will be presenting my case study for the subject money and banking. My topic is analyzing home mortgage financing. Then I will be using example of John and Mary's 300,000 loan from CNB Bank Berhad over 20 years at 8.25% annual interest compound halfly. So for the next slide, the mortgage detail, let's start with the um, principal. Hi, my name is Naadir Amzar bin Aslam. Today I will be presenting my case study for the subject money and banking. So my topic is analyzing home mortgage financing, and I'll be using the example of John and Mary 300,000 ringgit Malaysia loan from CNB Bank Berhad over 20 years at 8.25 annual interest compounded half throughly. So in this presentation, I walk through how the mortgage work, the impact of interest and compounding, how Bank Negara policy affect a borrower, and finally which mortgage time might be better for them, the 15 years and or 20 years options. So for the next slide, the mortgage detail. So let's start with the mortgage detail. John and Mary borrowed 300,000 ringgit Malaysia from CMB Bank Berhad at annual interest rate of 8.25%, which is compounded halfly. This means that the interest is calculated twice a year at 4.1.25% per period. The loan term is 20 years, and since it's compounded twice a year, they will have 40 total payment periods. So basically, every 6 months for 20 years, they will make one repayment. So next slide, half yearly repayment calculation now. To calculate the half yearly repayment, we use the financial formula, which is PMT PV multiply with bracket R 1 minus bracket 1 plus R bracket N. So PV is the loan amount, which is 300,000 ringgit Malaysia. R is the half year interest rate of 4.25%, and N is the total 40 periods. When we put all the into formula, we get a repayment of 50,440.14 every 6 months. That's the amount of John and Mary need to pay twice a year for the next 20 years to full settle their loan. So next is total interest over loan period. Now let's talk about the how much interest they are actually pay in total. If we take 50,000 for 440.14 per payment and multiply it by 40 payments, that's equals to uh 606 ringgit Malaysia. From that we subtract the original loan of 300,000 ringgit Malaysia. We see the original the total interest is 317,606. That's more than double the principal amount. So over time, John and Mary will end up with paying 106% interest compared to the original loan. This really shows how expensive long-term borrowing can become, especially interest is compounded. So next is amortization table first 5 years. Here we can see the amortization schedule for the first 5 years. In the beginning, most of the payment goes toward interest, and only portion goes to the principal. For example, in the first period, out of 15,440, around 12,375 goes to interest and only 3,065 reduces the loan balance. But over time, the interest portion slowly decreases while the principal portion increases. This means that as the loan gets smaller, less interest is charged and more of the payment goes toward paying of the actual loan. The impact of compounding frequency. This slide shows how compounding frequency affect payments. The more often interest is compounded, for example, the monthly instead of yearly, the smaller each payment becomes and the total interest paid over the loan period also decreases. In John and Mary's case, switching from annual to monthly payment saved them over 9,000 ringgit Malaysia in total interest. So compounding frequency can make a big difference in how affordable a mortgage feels. This helps borrower when our payments are made monthly instead of yearly. The payment period is much lower, for example, 2,556 per month instead of 1,126 per year. This makes it easier to manage household budgets. It also helps the principal amount to reducing faster since smaller but more frequent payment. Uh, the loan balance is decreasing steadily, and even though uh, effective annual rate might be slightly higher, the total interest paid end up being less. So overall, the more frequent payments help borrowers save money and manage finances better. So next, Bank Negara OPR impact. Now let's talk about how the overnight policy rate or OPR set by Bank Negara Malaysia affect mortgages. When the OPR goes up, bank raises their lending rates, which makes monthly mortgage payments more expensive. This means borrowers like John and Mary have to pay for each month, reducing affordability and slowing down the property market. On the other hand, when the OPR decreases, borrowing becomes cheaper and more people can afford to buy houses, which stimulates property demand. So, Bank Negara OPR decision have a direct impact on borrowers and the overall housing market. So OPR's effect on Malaysian households. This impact is especially strong because most Malaysian home loans are linked to variable interest rates. So whenever the OPR changes, borrower immediately feel the effect, according to research by Ismail et al. 2014. When the OPR increases, housing affordability decreases and loan difficult risk also go up, especially for middle and low income group. So while OPR is an important tool for managing the economy, it also directly affects the financial well-being of households. So for the three major borrowers risks. So now let's talk about the three major risks borrower face. First, interest rate risk. If rates go up, the repayment increase. For example, if the rate jumps from 8.25% to 9%, John and Mary's payment would rise quite a bit, putting pressure on their budget. Second, income risk of either of them loses their job, gets a pay cut, or faces illness, it becomes difficult to maintain the 50,000 ringgit for 440 half yearly payments. That can lead to penalty or even deposition. A third, property market risk. If property prices fall, the house value might drop below the loan amount. Inflation also reduces disposal income, making repayments harder to manage these risks. It's important for borrowers to having emergency saving and income protection. So why banks offering long-term housing loans? Now, from the bank's point of view, why do they love offering long-term housing loan? First, it's profitable. A 20 or 30 years loan provides banks with steady streaming of income from interest. In fact, CIMB's 2024 report shows 55.10 billion in home financing, a huge source of stable revenue. Second, it's low risk because the loan is secured by property. If the borrower cannot pay, the bank can recover losses through the collateral. That it helps customer retains long-term borrower tends to stay with the same bank, opening opportunity for selling other products like insurance or investments. Lastly, the interest support financial stability. Secure loan helps bank maintain a strong balance sheet and stable long-term performance. So next, government support for the first-time buyers. Now, next, let's look at the government role. In Malaysia, housing affordability remains a major issue. Housing prices rose 3.5% in late 2024, reaching an average price of 486,678, and there are over 158,000 unsold units. Currently, housing loans make up 58% of household debt, which shows how important home financing is to the economy. To support the first-time buyers, the government can offer the tax reliefs, housing subsidies, and low interest in schemes. Programs like the home ownership campaigns are good initiative, but more targeted reforms and better collaboration with banks are still needed to ensure the market stay inclusive and stable. So next slide. 50 years with air with 20 years mortgage comparison. Here's a side-by-side comparison between the 15 years and 20 years mortgage. For the 20-year loan, John and Mary pay 50,440 per half year, totaling 617,606 with 317,606 in interest. For the 50 years loan, they pay 17,616 per half year, totaling 528,480 with 235,078 interest. So by choosing the 50 years plan, they would save 82,527 in interest. But the repayment each time would be 2,175 higher. It's a trade-off, higher payment now, a big saving later. So next, which mortgage term is better? So which one is better, 50 years or 20 years? Well, it's depend on their financial situation. The 50 years loan helps them become debt-free faster, build equity sooner, and save over 82,000 in interest. It's a deal if they have stable high income, but the 20 years loan offer more flexibility with smaller payment, make it easier to